let's start writing the summary of the last class. Which question did we write a summary before this? 8. Okay, now write question number 9. Question number 9. Point number 1. Initial outflow would be taken as rupees 1 lakh. Would be taken as rupees 1 lakh as only 80% of the asset value. 80% of the asset value was paid on day 0. 80% of the asset value was paid on day 0. Full stop. However, depreciation will be calculated. Depreciation will be calculated for the entire value of the asset. Depreciation will be calculated for the entire value of the asset. Will be calculated for the entire value of the asset. Next point. Tax rate has not been given in the question. And the same was assumed as 30%. Next, question number 10. The company will be losing commission income. By purchasing the diagnostic machine. Full stop. This will be taken as opportunity cost. As opportunity cost. And the same would be adjusted with CF80. Full stop. This is because the commission income is post tax. Commission income is post tax. Question number 11. Point number 1. Revenues will have to be the incremental revenues. And the same would be calculated as post banta revenues minus revenues without the new system. Next point. Interest is to be ignored. As per as per reward exclusion principle. Interest is to be ignored as per reward exclusion principle. To be ignored as per reward exclusion principle. Question number 12. NPV versus IRR conflict. NPV versus IRR conflict. Split it into two. Life same, life different. Life same, life different. Life same, life different. Life same, put arrow mark down. Go ahead with NPV. Go ahead with NPV. Life different. Calculate EAB. Life different. Calculate EAB. Calculate EAB. EAB equal to NPV divided by present value annuity factor. NPV divided by present value annuity factor in bracket R comma N. Present value annuity factor in bracket R comma N. Question 13 is homework. Whatever notes you want to make, you can leave space if at all you want to write something. 13 you can leave space of 3-4 lines. Question 14. This is a problem where only outflows are given. This is a problem where only outflows are given. Only outflows are given. Full stop. We will have to compute present value of outflow. We will have to compute present value of outflow and then decide on the machine. Present value of outflow and then decide on the machine. Next point. Life of the two projects is different. Life of the two projects is different. And hence we will have to compute EAC. We'll have to compute EAC. EAC equal to present value of outflow. Present value of outflow divided by PVAF R comma life. PVAF R comma life. Question number 15. Question number 15. This is a problem on abandonment decision. Problem on abandonment decision. Problem on abandonment decision wherein we decide when to give up the existing asset. Wherein we decide when to give up the existing asset. Wherein we decide when to give up the existing asset. Next point. Initial outflow will be taken as NSV of the asset. Initial outflow will be taken as NSV of the asset. Will be taken as NSV of the existing asset. Will be taken as NSV of the existing asset. Next point. compute NPV, compute NPV, compute NPV, full stop. If NPV is positive, if NPV is positive, continue with the asset. If NPV is positive, continue with the asset, full stop. If it is negative, if it is negative, then we have to discard the asset. If it is negative, then we have to discard the asset. Question number 22. Question number 22. For modified IRR calculation, for modified IRR calculation, for modified IRR calculation, we will have to compute, we will have to compute the future value, future value, we will have to compute the future value of all interim cash flows, future value of all interim cash flows, of all interim cash flows by compounding, of all interim cash flows by compounding them at cost of capital, by compounding them at cost of capital, by compounding them at cost of capital. Full stop. Next point, this will now become one outflow and one inflow situation, one outflow and one inflow situation, one outflow and one inflow situation, and calculate IRR in the normal manner. Calculate IRR in the normal manner. Calculate IRR in the normal manner. Question number 23. Point number 1. IRR is the rate of return. IRR is the rate of return. Is the rate of return at which NPV of the project is 0, at which NPV of the project is 0, full stop. This will help in calculating the initial outflow. This will help in calculating the initial outflow. Next point, PI can help in getting the present value of inflow, can help in getting the present value of inflow, and accordingly NPV is computed. Accordingly NPV is computed. Next point, payback will be calculated. Payback will be calculated in the normal manner. Will be calculated in the normal manner. Next, we can reverse work. We can reverse work with NPV. We can reverse work with NPV to get the cost of capital. We can reverse work with NPV to get the cost of capital. Reverse work with NPV to get the cost of capital. Clear? This is what we have done till now. Now I will move to the next decision, which is a significantly important one, which is replacement decision. Now till now we have done two types of decision. First one was new purchase. This decides whether to buy an asset or not. When you do a new purchase decision, okay, let me keep it like this, particulars, new purchase, abandonment. These were the two types. Step 1, in new purchase it was capital expenditure, and here it was NSV, net salvage value of existing asset. Step 2 had remained same, step 3 had remained same, step 4 had remained same. You to consolidate, calculate NPV, all of that was same. Now, new purchase talks about buying an asset. Abandonment talks about selling an asset. Replacement talks about both. Replacement means buy a new asset and sell an existing asset. So, replacement is technically buying a new asset and selling an existing asset. Now, I can solve this problem in two ways. The problem gives you the cash flows related to the new machine. Ignore replacement problem. Go back to the normal capital budgeting. Step 1, capital expenditure, working capital. Step 2, in between flows, revenues, all of that you do. Step 3, terminal flow, calculate NPV. Ignoring it's a replacement decision problem. Any machine they are going to buy, you calculate NPV in the normal manner. Whatever we have been doing till now. Similarly, NPV for an abandonment decision. What is abandonment? Step 1, net salvage value of existing asset at year 0. Working capital. Step 2, in between flows. Step 3, terminal flow. Step 4, calculate NPV. NPV positive, continue with the asset. NPV negative, discard the asset. This is what we have learned till now. Now, when you do a replacement decision, there will be two types of scenario. One, you will do non-incremental method. Second is incremental method. Now, non-incremental is the preferred way of doing a problem unless the question forces you to do incremental. There will be certain types of problem which will force you to do an incremental method. Is the solving significantly different? No, it's not materially different. It's broadly the same thing. In non-incremental, what you will do is you will calculate one NPV for old machine, one NPV for new machine, and then compare them both to decide whether to continue with the old machine or buy a new machine and sell the old machine. So, separate NPV for old machine, separate NPV for new machine with the same set of steps. So, in non-incremental you can have like this: old machine 10 lakhs, new machine plus 20 lakhs. Both are plus. Old machine has an NPV of 10 lakhs, which means I can continue with the old machine. New NPV has new machine has an NPV of 20 lakhs, which means I should buy the new machine. Between the two, I'll obviously prefer the new machine because it gives me a better NPV. So, new machine is going to replace the old machine. If you calculate the NPV, steps remain the same, method of calculation remain the same. You will separately do it for old machine, separately do it for new machine. Now, what is incremental is somewhere you are going to combine the cash flow and it will say NPV is equal to 10 lakhs. What is 10 lakhs is the additional NPV. What is 10 lakhs is 20 lakhs minus 10 lakhs. If you get positive NPV, go ahead with replacement. If you get a negative NPV, don't do the replacement. So, in an incremental method, you are going to do something in a way that you combine two cash flows and get one incremental NPV rather than the overall NPV. We will get something called as incremental NPV. Now, when do I use incremental method? Two scenarios. Only outflow. If the question gives information only on outflows, then my non-incremental method may not make sense. I'll have to shift to the incremental method of analysis. Only outflows are there. Second, if it asks for anything other than NPV. If the question asks for anything other than NPV, suddenly they say calculate the IRR, calculate the payback of replacement decision, calculate the discounted payback. All of that I cannot do it under. Now, I cannot say payback of old machine is 4, new machine is 3, so incremental is 1. That is not going to work out. So, your non-incremental method cannot be used for any other technique other than NPV. NPV because it is addable. Profitability index is not addable. NPV is addable, subtractable. Whatever you want to deduct it, you can deduct it. You want to add it, you can add it. So NPV is something which can be added, but you cannot do anything with any other techniques. So for NPV alone, I can use non-incremental method. Any other technique the question talks about, it has to be only incremental method. Now when I solve a problem, is the problem going to be significantly different? No. The way of solving is going to remain more or less same. I'm going to straight away directly go to the problem now to explain you the method of solving. The only thing is, you should not confuse yourself with old machine, new machine and all. You can think it like three different. If the problem talks about two machines, there is a problem number 1 which is on old machine, problem number 2 which is on new machine. Old machine is an abandonment problem, new machine is a replacement decision problem. Clear? Any doubts on this? Let's now start with this question. Go through question 16. Go through the question. Now, ABC company has been producing a chemical product by using machine Z. So machine Z is your existing machine. Now the management is deciding whether to replace by X or Y machine. So whatever is given for Z is a problem number 1. Step 1 initial outflow, step 2 in between flows, step 3 terminal flow. You look at the information and calculate one NPV. Z is a separate problem altogether. This is problem number 2. This is problem number 3. So we have 3 different problems. Obviously I would like to combine the steps, so I may write particulars in step 1 3 columns, step 2 3 columns, step 3 3 columns. We may write it like that, but as such, from a solving point of view, it is like 3 independent problems for you. So there is a problem number 1 on Z, problem number 2 on X, problem number 3 on Y. All of this is given. Using NPV method, you are required to analyze the feasibility of the proposal and make a recommendation. They want us to analyze using NPV method. So if it's NPV, non-incremental can be used. That's first thing. Second, is the project giving only outflow or are there inflow also there? If only outflow, then again NPV will fail. Inflows are there. Okay. So if inflows are also there in the question, then I want to solve this problem under non-incremental method. That is 3 separate problems. Z is a separate problem, X is a separate problem, Y is a separate problem. We are going to do it as 3 individual problem. Working note 1, initial outflow. Working note 1, initial outflow. Particulars Z, X, Y. I will not fill X and Y. I will first do everything of Z, then we will fill everything of X, then fill everything of Y, so that you find it that it's exactly the same what we have been doing. It's not a new scenario altogether. Particulars Z, X and Y. Now let's restrict our analysis to machine Z as of now. Machine Z. Machine Z is already with us, or we have to buy this? Already with us. So we don't buy it. So we call it as NSV, net salvage value of Z at year 0. Net salvage value of Z at year 0. Now leave some 3 lines and calculate NSV. In bracket I'll write note 1. How is NSV? Sale value less book value, gain, loss, paid, saved. So leave some 3 lines. Calculation of NSV. What's the starting point for NSV calculation? Sale value. What is the value at which Z can be sold now? 1,10,000. So write sale value 1,10,000. Any book value given? 1 lakh. Book value is 1 lakh. Gain is 10,000. Gain is 10,000. Gain is 10,000. On this gain we have to pay tax. Tax paid. What's the tax rate given in the question? 5,000. And NSV is 1 lakh. Let's focus only on machine Z. I will not come to other machines till it's needed. We will focus only on machine Z. 1,05,000. Any doubts in this? So if I want, I can sell this machine for 1,05,000 today. If we need it, we can sell it for 1,05,000 today. Clear? Any doubts on this? Not for 1,10,000. You are not going to get 1,10,000. You will get only 1 lakh. So in brackets, 1,05,000 NSV. Point number 2, working capital. Any information on working capital? Anything given, not given, we'll write 0. No, 0. Now, I will have a point number 3. I'll tell later. This is for basically for X and Y. I need some other point. So, as of now, you can leave a line gap and put a total. I'll need one more line gap in between. That's not for machine Z, but it's needed for X or Y. So you will understand that later. As of now, we are analyzing machine Z with 1 line gap. Why 1 line gap? You will understand later. So initial outflow is done. Any doubts on 1,05,000? Can we proceed? Clear? Next, working note 2. In between flow. In between flow, particulars machine Z, machine X, machine Y. Z is what we will focus now. Particulars machine Z, machine X, machine Y. Start with revenues. Read it carefully and let me know the revenues. Let's focus only on machine Z. Revenues. How many units will be sold by machine Z? How much? 2000 hours into 8. 2000 hours into 8. Any doubts on this? 16,000 units into what is the selling price? 20. So write revenues. Any doubts on 16,000? Revenues is 3,20,000. Revenues 3,20,000. Let's look at the expense. What is the first expense? Which one? No, before all of that, let's first deduct material cost. All those variable costs, let's deduct it. Less material cost. Less material cost. Any doubts on 16,000 units? Material cost is going to be 16,000 into 10 minus 1,60,000. Material cost 16,000 into 10. Then we have variable running cost. Variable running cost. Variable running cost. How much is that? 48,000. Variable running cost is 48,000. Then we have fixed cost including depreciation. Can you exclude the depreciation and tell me how much will be the fixed cost? Removing depreciation, what will be the fixed cost number? That is including depreciation. What will be the depreciation of, okay, what will be the depreciation of machine Z per year? It will be 1 lakh minus 10,000 divided by 5, 18,000. Fixed cost is 92,000. So I subtract 18 from it. I subtract 18 from it. Any doubts on the depreciation of 18,000? 18,000 is 1 lakh of book value minus, your book value today is 1 lakh minus the salvage value of 10,000 divided by 5 years, 18,000. 92,000 is what is given. From this you remove 18 and you get 74. Now you can write 74,000 and leave one line gap. Don't write PBDT. I will have to fill one more item. Leave a line gap and then do PBDT. Less fixed cost 74,000. You leave a line gap that's needed for X or Y machine and do PBDT. 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 Any doubts on PBDT? Clear? Can we proceed? Less depreciation. Less depreciation 18,000. You can. I have been doing this format. Ideally I would put it as directly 92,000 and go ahead. It will make difference in only few questions. We have been used to this format, that's why I have done it. You put 92,000 directly, you get PBT of 20,000. Ideally in this question we should have put it directly itself, just getting used to the format, so I didn't change it. PBT 20,000. Get till CFAT quickly. What's the tax rate? CF8 is 28,000. Any doubts on this? Can we proceed? Any doubts? Working note 3, terminal flow. Particulars and 3 machines. Now, if I have decided to continue with machine Z, we wrote an initial outflow called as NSV of 1,05,000. After using it for 5 years, if I sell today, it will not be at 1,05,000. After using it for 5 years, there will be a different sale value. They said resale value now is 1,10,000. That's in 2018. You use it for 5 years and sell it in 2023, you are not going to get the same amount. What are they talking about salvage value after the 5 years? Something would have been given in the question. 10,000. And what will be the book value? Book value is 1 lakh minus 18,000 into 5. 1 lakh is the book value today. Every year you said depreciation is 18,000. So 18,000 into 5. It's same 10,000. Book value is 10,000. Sale value is 10,000. I'm directly writing NSV. When sale value and book value is same, no tax. We are not going to show detailed calculation. I am writing 2 net salvage value for machine Z. One I wrote in step 1 and one I am going to write here. Both of these are different. One was 2018 value and now what we are writing is 2023 value after 5 years. Net salvage value. For machine Z, calculation is not required. X and Y if we require, we will write it in note 1, note 2, whatever way we want to do it. We will write a note and do it. Machine Z 10,000. Machine Z 10,000. Next, working capital, recapture of working capital. Any doubts on this? I've done analysis only of machine Z. I'll continue to do machine Z analysis. We'll come to other machines in some time. Let's focus, close everything related to machine Z. Any doubts till now? Working note 4, computation of NPV. The format will undergo slight change. So I'll give you the columns. Working note 4, computation of NPV. Computation of NPV. Year is fine. Cash flow will have 3 subcolumns. Machine Z, machine X, machine Y. Year, cash flow. You will have to write 3 parts. Machine Z, machine X, machine Y. PVF at, what is the percentage? PVF at 10%. DCF again 3 subcolumns. DCF will have 3 subcolumns. Machine X, Z, machine X, machine Y. We will not focus on other machine as of now. The focus will be only on machine Z. The basic thing which I want to explain is replacement is not something new. People struggle a little bit with replacement. That's why I'm doing it separately itself, Z separately, X separately, Y separately, rather than combining them and confusing. Clear? Any doubts on the format? Now you can fill the cash flows of machine Z and let me know the NPV. How much is the outflow? You write in year 0. Inflow you write it in year 1 to 5. Terminal flow write it separately for year 5. Any doubts on machine Z? If this is done, then we'll move to machine X and then start capturing whatever is required. Any doubts on machine Z? I'm not taught you anything new today till now. Machine Z, whatever was done was explained in the last class. Nothing new has been taught till now in replacement. So machine Z was a separate problem altogether. Now machine X is a separate problem altogether. Can we proceed to machine X? Clear? Now let's go to machine X. What is the initial outflow for machine X? 1,80,000. The only thing is, in your working note I told you to leave a line gap. Call it as capital expenditure. That is capital expenditure. And against that you will write 1,80,000. That line is capital expenditure, and again that for machine X is 1,80,000. No concept of NSV, no working capital. The line gap was to write capital expenditure 1,80,000. Any doubts on this? Clear? Can you proceed? Any doubts? Next, let's go to step 2, which is your in between flows. The format is already there. I just need to put in figures. The format is anyway already created. What will be the revenues of machine X? Same 3,20,000. 2,000 into 8 into 20. 320. Material also 160. Material also 160. Let me know in case there is a doubt. Anybody has a doubt, please let me know. Variable running cost 16,000 units into 1.5. 16,000 units into 1.5. What is going to be the depreciation amount here? Want your participation, please. 33,000. So from 1,08,000 remove 33,000. How much? 75,000. That line gap, let it be there. It's not going to come for machine X, it will come for machine Y. So let the gap be as it is. PBDT. PBDT is 61,000. Depreciation is 30. PBT 28. You guys can fill it. I don't have much to explain here. Now, any doubts? 47,000 you have got? Anybody has a doubt on 47,000? Can I proceed? What is the sale value after 5 years? 15,000. What will be the book value after 5 years? Same 15,000, because it's 180 minus 33,000 into 5. So, I am straight away writing 15,000. Consolidate, calculate NPV. Put the values for machine X now. Consolidate, calculate NPV. Consolidate and compute NPV. Let me know in case there are doubts. Can we shift to machine Y? Any doubts on this? Anybody has any doubts on this? Machine Y, what's the initial outflow? 2 lakhs. So fill it in working note 1. Two lakhs is the outflow. How many units will be sold for machine X? What will be the revenues? Machine Y, sorry. It's going to be 22,000 hours into 12. It's going to be 2,000 hours into 12, which is 24,000 into 20. 4,80,000. It's 24,000 units. $24,000 units. Tell me the depreciation and accordingly the fixed cost. Depreciation and accordingly what will be the fixed cost figure? What will be the depreciation? 36,400. If you remove that, what is the fixed cost? 95,600. Don't go to PBDT. We'll fill that line gap now. 95,600. Any doubts on 95,600? 1,32,000 minus the depreciation number. Now this line gap is because there is one more expense given in the question. What is that? Advertising. Additional cost of 8,000 per annum would be incurred on special advert to sell the extra output of machine Y. Less special advertising. Special advertising. How much is that? 8,000. Beyond this, it is the same thing. You guys can complete it. Yeah, any doubts? Which one? 36? Okay, sorry. It will become 56,400. ठीक है. So we have done it as 3 independent problems to make you understand that replacement is not something new for you guys. Whatever you have learned till now, exactly the same thing is working here. Nothing new for us. It's more or less continuation of the same thing. Net, these are the NPVs: 7358, 7492 and 24990. These are the 3 different levels of NPV we have. Can we proceed? Now, if I just analyze machine Z on a standalone basis, should I continue with machine Z or discard? Only machine Z analysis. Continue. Only machine X analysis, should we buy or no? We should buy. Machine Y, should we buy or no? All the 3 are acceptable machines. In all those 3, I'll go with machine Y. Because of this, I'll have to sell off machine Z. I'll have to, because I need only one machine. So the final conclusion is the company should buy machine Y as it has the highest NPV and discard machine Z. So now write the conclusion. The company should buy machine Y as it has the highest NPV, should buy machine Y as it has the highest NPV and discard machine Z. Any doubts on this? This is called as non-incremental method, separate analysis. When it comes to incremental also, nothing material is going to change. You will understand as I do the next problem. Let's shift to question 19. Go through question 19. Okay, coming to this question talks about some replacement of machine and all. Then finally they have mentioned calculate NPV, calculate IRR. If I have to calculate IRR, I will have to use the other approach which I was saying, incremental approach. Analysis will broadly remain the same. First, I will analyze the existing machine through the 3 steps, not the 4th step. 4th step alone will not be done. You will do 3 steps of existing machine and then 3 steps of new machine. You will do it separately, and then I come to something called as incremental analysis. Working note 1, initial outflow. Initial outflow, particulars, existing machine, new machine, existing machine and new machine. Now let's analyze only data relating to existing machine. Let's not confuse with the new machine for the time being. Existing machine can be sold for what value? How much? 2 lakhs. Is it 150 or 250? Market price is 150, but the supplier is ready to take it at 250. So if you have these 2 scenarios, you will obviously choose 250. If somebody tells you that I will pay you 2,50,000 or 1,50,000, we will obviously choose 2,50,000. So the sale value of this existing machine today is 2,50,000. By continuing, I lose the opportunity of earning this 2,50,000. Now there is some book value given in the question. So let's book value do the NSV calculation. NSV of existing asset in bracket note 1. Leave some 3 lines gap. Calculation of NSV. What's the sale value? 2,50,000. Book value 1 lakh. Capital gain 1,50,000. Tax rate is how much? What is the book value? Book value is 0. It has an accounting book value of 1 lakh and it has been fully depreciated for tax purpose. I am doing this calculation only because of tax. I am not doing for any other purpose. Because of income tax only we are doing this calculation. So in your books of accounts you have some value, but in income tax you have fully depreciated it. When you learn PGBP you will keep learning about this. There is a different depreciation in Companies Act, different depreciation in Income Tax Act, that leads to a difference in the value of the asset. So in this case what has happened is in your books of accounts you are yet to charge off depreciation, but in income tax you went ahead and charged off fully. So in income tax it has a value of only 0. So less your book value, adjust it as 0. Book value is 0. Tax will be 40% of this. It has only an accounting book value, not the income tax value. So you cannot go to the IT authorities and say that give me some claim for book value. They'll say nothing doing. You have already depreciated it fully. When I have already depreciated it fully, I cannot claim any book value under income tax. So NSV is 1,50,000. So existing machine minus 1,50,000. I'll not write about working capital anyway, nothing is there. So leave a line gap and put a total. That line gap you'll understand later why. I'll analyze only existing machine. I'll not go to new machine till now. Existing machine 1,50,000. Any doubts on this? Can we proceed? Any doubts? Working note 2. In between flows. Particulars existing machine. Particulars existing machine and new machine. New machine will capture it in some time. Let's focus only on existing machine. Is it possible to calculate revenues? Yes. So let's start with revenues then. Revenues. $80,000 into 200. Revenues 80,000 into 200. Then let's keep deducting all those items. What's the first one? Material, wages, supervision, repairs, power, depreciation, corporate overheads, all of that. Please keep deducting it. Less materials. Less supervision. Materials is 80,000 into 75. Wages is 80,000 into 51.25. Supervision 80,000 into 20. Repairs is into 11.25. Power and fuel is 15.5. Allocated corporate overheads is how much? 10. How much? 10. Into 0. Again, in the initial rule I had said general overheads, corporate overheads, allocated, apportioned have to be ignored. I have already explained this. It is 0. 8. If you have made a mistake, correct with a different pen. 80,000 into 0. In short, you have to ignore this item. Be it 80,000 units or 1 lakh units, doesn't make a difference. This item has to be ignored. PBDT will be 21,60,000. Allocated corporate overheads is not to be considered in our analysis because it is an irrelevant item. This is not specific to the project, it is specific to the corporate. How much is depreciation? How much? Is there any value available in income tax for you to claim depreciation? How are you going to claim depreciation? The income tax value is 0. The purpose of writing depreciation is again to calculate only tax. If tax is not there, I don't even write depreciation. So where is the point of putting a depreciation as 80,000 into 0.25? That is your Companies Act depreciation. That doesn't matter. In income tax, they are not going to allow you any depreciation benefit because it's already fully depreciated. So write a 0 again. These were the two hidden adjustments. Balance, there is no adjustment. Any doubts on 12,96,000? Can we proceed? Any doubts on this? Can we? Working note 3. Terminal flow. Working note 3, terminal flow, particulars and existing machine. Existing and new machine, obviously. Now, what will be the sale value of this machine after 5 years? 35,000. Will there be any book value? So, there is going to be some tax and all is going to come. So, let us calculate here directly. Sale value 35,000. Capital gain 35,000. Tax paid is 14,000 and NSV is 21,000. We will not go ahead and calculate NPV. So, what is to be done I will explain later on. We have done all this. I am going to repeat all of this now for the new machine. The entire stuff is going to be repeated for the new machine. Clear? Any doubts on the existing machine analysis? Let us go to the initial part. Step 1. Now, instead of starting with NSV, we will start with capital expenditure. What's the capital expenditure? How much? 60 lakhs. Capital expenditure is 60 lakh. Next, let us go to in between flows. Similar analysis. I don't have much to explain now. What will be the revenues? 1 lakh into 200. 1 lakh into 200. Materials is 1 lakh into 63.75. What will be the depreciation? 11 lakh. You will not go by what is given here, because this is again going to be your accounting depreciation. In income tax, we will follow the SLM method of depreciation for income tax purpose, which is 60 lakh minus 2,50,000 divided by 5 years. So there is a depreciation adjustment, there is a corporate overheads adjustment. Nothing beyond that there is in this question. These two are the hidden, are the most important adjustment of this question. So 60 lakh minus 2,50,000 divided by 5, how much? 11,50,000. I'll tell you what is to be done for incremental once we are done with the cash flow. It's now going to be materially different. Any doubts on this? Clear? Can you proceed? Next, for new machine, what is the sale value? 2,50,000. Any doubts on 35,80,000? Book value will also be 2,50,000. no gain, no tax. Clear? Can you proceed? Any doubts on NSV figure? Okay, now please listen. When it comes to incremental method, what I have to do an extra step. Now write working note 4, calculation of incremental cash flow. Calculation of incremental cash flows, particulars, new, existing, new and incremental. Particulars, existing, new, incremental. Existing, new and incremental. Existing, new and incremental. Start with year 0. Year 0. What's the year 0 outflow for existing machine? 1,50,000. I'm just copy pasting the numbers. I'll tell you what is to be done. New machine 60 lakhs. Year 1 to 5. Year 1 to 5. Existing is 12 lakh and new is 35 lakh 80. Then again year 5, 21,000 and 2,50,000. We used to separately calculate NPV for this. This is not going to work out because IRR is also needed. Now the problem is no more existing and new, it's only incremental. What is incremental is new minus existing. So minus 60 lakhs minus of minus will become plus. Minus 60 lakhs minus of minus will become plus. So you can ignore all of this, it's new minus existing, and this is the cash flow structure. Here cash flow, PVF, DCF, this will give you NPV. You want to do IRR, you will have to do one positive, one negative, all of that remains same. But the problem will work with this cash flow. This is what you are going to use for anything to be calculated. The cash flows are, initial outflow is not 60 lakhs, not 1,50,000, it's 58 lakh 50,000. New minus old. Minus 60 lakhs minus of minus. New minus old is how much extra are we getting. Clear? Any doubts on this? So get the incremental. Get the incremental one, and then now you go ahead and calculate NPV. IRR is homework. Do NPV alone. Your working note 5 will be calculation of NPV. Now with this you will have to calculate NPV. IRR is something you can do at home. Let's close NPV alone. It's no more a problem of existing and new, it's only incremental. Only the additional number is to be considered for analysis purpose. But IRR, what will you do? The problem is with IRR. NPV is fine. I can do it separately and find the difference. IRR, I can't do anything. So for IRR purpose, you need this cash flow. That's why I said where IRR is to be calculated or where there are only outflows, this is the preferred method. If this NPV is positive, we go ahead. If it's negative, we reject it. Follow whatever is the factor given in the question. Let me know in case there are doubts. Can you proceed? IRR is something which I leave it to you. You do it at home. Any doubts on the NPV number? 19,20,284. The conclusion is we will have to go ahead with the replacement. Whenever NPV is positive, we'll go ahead with the replacement. Any doubts on this? Clear? Can we proceed? Can I move to the next question? Go through question 17. Okay. Now this problem is talking about an assembly line which can be replaced with an automated one. If you look at the benefit of that is the expenses will reduce from 5,10,000 to 2 lakh. So the problem is talking only about outflow, no information on inflow per se, because it's a problem, it's a scenario where there is going to be a cost reduction. You are trying to reduce the cost. We'll try to do it in the same way. Step 1, initial outflow separately for existing, separately for new, all of that separately. Then if I have to do incremental or non-incremental, I'll explain later on. Let's start working note 1, initial outflow. Working note 1, initial outflow. Initial outflow. Particulars existing and new. Particulars existing and new. Now let's first discuss whether we have to do a working or we can write it separately. What will be the sale value of this assembly line today? 40,000. What will be the book value? Read it carefully and let me know. Read it carefully, read it carefully. It's not 0. It is being depreciated to 0 over a life of how many years? 5 years. How many years back did you buy this? 3 years. So only 30,000 would have been claimed, still 20,000 is left over. It is over a period of 5 years. So 50,000 divided by 5, that is the depreciation they would have been charging. That has been charged only for a period of 3 years. So you still have 2 more years in which you can claim depreciation. Clear? Any doubts on this? So let's start. Net salvage value in bracket note 1. In bracket note 1, leave a line for capital expenditure. Note 1, calculation of Nsv. How much is the sale value? 40,000 less book value. You're clear on the adjustment of book value? It's 50,000 rupees bought 3 years ago. First year 10,000 gone, another 10,000 gone, another 10,000 gone, and now we have a book value of 20,000. Sale value less book value. Capital gain, tax paid. What's the tax rate? Nsv. Any doubts in this? We'll write minus 32,000 here. No working capital and all. Any doubts on 32,000? Okay. Now please listen. Okay, open the working note to in between flows. I'll tell you the adjustment which is going to happen there. Don't write any columns. Okay. Now when I'm doing my in between flows for existing machine, the cash flow is not going to be same for all the 5 years. Why not same? Because of an item called as depreciation, which is going to be there only for year 1 and year 2. Because we have already claimed 3 years of depreciation, I have another 2 years which I can claim, but the cash flow is to be calculated for a period of 5 years. Further period of 5 years, they have said the old equipment will last for So in this 5 years, I cannot go to the income tax and say that give me depreciation every year. They are saying nothing doing. You have already claimed 3 years. Another 2 years you can claim depreciation. Beyond that, no more depreciation is to be charged. So what we will do is, listen for a minute, particulars existing will have a breakup called as year 1 to 2 and year 3 to 5. This issue will not be there for new. So new will have only one thing, which is called as year 1 to 5 together. That is going to be together. But for existing machine, I cannot combine it. And the reason for not combining it is depreciation. The reason is only because of depreciation. Clear? Any doubts on this? Anybody has any doubts on this? Open the structure now. Can we start? Now, let's analyze existing machine on a standalone basis. Don't keep comparing, you will get confused. Revenues, any revenue given in the question for existing machine? What is the only item you have for existing machine? Expenses will be 5,10,000 and it will reduce to 2 lakhs in the other machine. Listen for some time. I'll write revenues as 0. Expenses is going to be 5,10,000. I'll get PBDT as 5,10,000. Depreciation is how much? 10,000. PBT 5,20,000. Tax rate is how much? On loss you will save tax. So minus into 0.4. Any expense you incur, you are going to save tax on that. PAT, depreciation, CFAT. Depreciation is adding back 10,000 and my CFAT is going to be negative 3,02,000. Let it be negative 3,02,000. When you do new machine, you will get negative 1 lakh or 2 lakh, some lower number. Why I use incremental method is, if I do NPV of both these cash flow, I will get a negative answer only, because both are going to be negative. But when you do new minus old, minus 2 lakhs, minus of minus 3 lakh will give you a positive answer. That is why we are going to do incremental method when there are only outflows in a question. My analysis remain the same. Existing I'll analyze it separately, new I'll analyze it. If you try to combine, you will get confused. So never ever combine the cash flow. Do it separately existing, do it separately new machine. So existing machine, this is going to be 3,02,000. Here the only change is there is no depreciation. There is no depreciation. Because of that, it is negative 3,06,000. Negative 3,02,000, negative 3,06,000. Let's not worry about negative answer, because year 1 to 5 new machine will have a lower negative number. When you have a lower negative number, the benefit is you will do something called as new minus old. When you do this new minus old, you are going to get a better answer. Clear? Any doubts on this? The moment you do this new minus old, you will get a positive number. Clear? So let's analyze existing separately, new separately. This will be existing analysis. Complete this. That's why I said no existing, no new. Don't compare. Where does the saving come? Automatically it comes when you do new minus old. When you do new minus old, you are going to get a positive answer. If I just go by saving, then I'll have to analyze only that is directly writing the incremental number. When you, the moment you say saving, you are comparing two things. I'm saying let's not compare. Separately existing, separately new. Let this be a negative number. If you try to combine, you will get a confusion. So in order to avoid that, I am doing existing separately, new separately. Step 1, step 2, step 3 remain same whether you follow incremental method or non-incremental method. The change comes only later on. Wherever there are losses, we'll have to consider tax saving. Can I proceed to working note 3? Any doubts on this? Anybody has any doubts on this? Next, working note 3, terminal flow. Terminal flow. Start with sale value. Particulars, existing machine, new machine. I am not writing anything in new machine, I will write it later on. At what value will you sell the existing machine now after using it for 5 years? How much? 20,000. Today it can be sold for 40,000, but if you use it for 5 years, you can sell it for 20,000. Less, what will be the book value? 0. Capital gain. Capital gain 20,000. Tax paid is 8,000. NSV is 12,000. Any doubts on this? You're going to sell it for 20,000, but there's no book value attached with it. So you're going to have a profit. On that, you'll have to pay tax and you get an NSV of 12,000. Now we'll go back to from working note 1. Any doubts on this? In that line gap, what will you write? Capital expenditure. Capital expenditure. How much? 10 lakhs capital expenditure. 10 lakhs capital expenditure. What is the revenue this new machine is going to generate? On a standalone basis, is there any revenue? Don't talk about cost saving, any revenue? 0. Expenses are 2 lakhs. PBDT. What will be the depreciation? 10 lakhs divided by 5. 10 lakhs divided by 5. 2 lakhs. PBT is 4 lakhs. CF80 is 40,000. Any doubts on this? Can we proceed? Step 3. What will be the sale value of this new machine after 5 years? 0. Book value? 0. No gain, no tax, no NSV. Now I'll consolidate this. First get the incremental number and then calculate NPV. Working note 4. Why incremental method is everything is negative here. Working note 4. Calculation of incremental cash flow, particulars, existing, new, incremental. You can write it separately for all the 5 years itself, because amount is going to change in few years. Better to write it separately itself for the 5 years. Everything is there in your notebook. You just need to capture the appropriate number. Incremental will be new minus old. Get the NPV of that. Positive, go ahead. Negative, reject it. New minus old. Minus 40,000, minus of minus. It will be new minus old. We're getting a negative NPV, so we'll not go ahead with the replacement. Let me know in case there are doubts here. Can we proceed? Any doubts on this? Can we? Okay, I'll move to question 18. Now listen, we'll do question 18 now. There will be two more questions which will be pending on capital rationing. This will be covered in the end. I'll not do it in the next class. Next class I want to start with a fresh topic. So we'll see those two questions in the end. In case we don't get time, I'll see what is to be done. So as of now, let's start with question 18. Any doubts till now? Let's do question 18, go through this. Okay, now coming to this question, they've asked about a machine which has to be replaced. Either I can replace it now, the machine can be replaced now with a new machine which is more efficient and will provide a cash inflow of something. Company Y wants to know whether it should do the replacement now or wait a year, with a clear understanding that the new machine is the best. So the problem is not whether to replace or not. They have already decided that they will go ahead with replacement. So no positive, negative, I am not going to debate on all of that. They have clearly said we are going ahead with replacement. The only thing is, do you want us to replace it now or wait a year later? Let's analyze both the scenario and then we'll give an advice to them. Working note 1, calculation of NPV. Calculation of NPV if the asset is replaced today. Calculation of NPV if the machine is replaced today. Replaced today. 4 columns: year, cash flow, PVF, DCF. Year, cash flow, PVF, DCF. PVF at what rate? 10%. PVF at 10%, DCF. Year 0. Now replace today means you are going to sell it today. At what price can you sell the old machine today? No tax and all, direct amount. What is the amount at which you can sell it? How much? So listen for some time, plus 80,000. At what price can you buy the new machine? Plus 80,000 minus 1,50,000, plus 80 and 1,50,000. After buying the new machine, what is the operating cost of the new machine or the revenue of the new machine? It will provide a cash inflow of 80,000 for a period of 3 years. So 1, 2, 3 plus 80,000. 1, 2, 3 is plus 80,000. I want what is the NPV for this. Year 0 minus 80,000, sorry, plus 80,000 minus 1,50,000, plus 80 is because you are selling the old machine. See, the decision is already done. We are going to do replacement. When do we replace is the analysis now we are doing. So plus 80 I am selling it off, minus 150 I am buying the new machine. The new machine will give me 80,000 in the first year, 80,000 in the second year, 80,000 in the third year. Calculate the NPV and tell me. What's the discount rate? 10%. $2.70,000 Any doubts in this? 128,960. This looks to be a feasible option, but let's analyze the next option also, because I have to decide between these two which one to opt for. Working note 2, NPV if the machine is replaced a year later. If the machine is replaced in year 1, 4 columns. Year cash flow, PVF for 10% and DCF. Okay, now listen for some time. See, this year 0 is technically a single day, that's all. It's a single day in which you buy and sell the machine in the option 1. Here on day 0, I'm not going to do anything because I'm going to continue with the machine itself. So on year 0, technically nothing happens. Listen for some time. Year 0, the cash flow is going to be 0. You don't do anything. Year 1, you will use the old machine for 1 year. You will use the old machine for 1 year. When you use it for 1 year, you earn some revenue. What do you earn? The question would have given. How much? 40,000. After using it for 1 year, you will sell it for some value. What is the sale value? 70,000. After selling it for 70,000, you will go ahead and buy the new machine. New machine you will pay how much? 1 lakh. So 40,000, 70,000 and 1,50,000. After doing this, year 2, year 3, year 4, 80, 80, 80. Because the new machine will give you 80,000 for 3 years. So use the old machine for 1 year, 40,000. Sell it off 70,000. Buy the new machine 1,50,000. Nothing happens on day 0. So I have just straight away written a 0. Clear? Any doubts on this? Calculate the NPV. Any doubts on 1,44,440? Clear, can we proceed? Okay, now please listen. Prima facie it may look like that it is to be replaced in year 1 because 1,44,000 is better than 128. But we ignore one critical aspect. Option 1, the NPV is 128 in 3 years. Option 2, the NPV of 144 is in 4 years. So both are ideally not comparable, and to make them comparable you will have to calculate EAB, because the first option is only for 3 years, the second option is for 4 years. So I cannot compare them. If I make a comparison like this, it will lead to wrong decision. So next working note, calculation of EAB. Calculation of EAB. Particulars replace in year 0, replace in year 1. Replace in year 0, replace in year 1. Starting point is NPV. NPV is 128,960. 128,960, 144,440. 128,960 and 144,440. Life. How many years is this year 0 replacement NPV? 3 years, and the other one is 4 years. Three years and 4 years. Present value annuity factor. Present value annuity factor. Present value annuity factor. Annuity factor is, for 3 years, what is the factor? 2.487. 2.487. The other one 3.0. Okay, sorry, 3.170. ठीक है. EAB. EAB. Clear? Any doubts on this? Any doubts on the EAB part? Now, based on the EAB, you will have to write your decision, and the decision is what? Replace in year 0. I'll end it with this. I need to leave a little early now, so I'll end it with this. Tuesday, I'm going to send in group the question paper on capital budgeting test. So test will start from Tuesday. I'll send it in group. I'll collect only on Thursday. I'm not going to collect on any other day, only on Thursday. If you're absent, present, doesn't matter. I'm not going to give you any permission and all. On Thursday, so you have time on Tuesday, Wednesday to write your test. Thursday morning, you'll have to submit it to me. If you submit it, great. If you don't submit it, it's your option. I cannot keep forcing people to write test. If you write test, you will understand your level of preparation. So Tuesday or Monday night itself, I'll send the paper. And on Thursday morning, I'll collect it. So whoever gives it on Thursday, I'll collect it at once and correct and give it back. If you are not giving it on Thursday, I'm not collecting on other days.